So I've been on a panel for Banking as a Service talking about embedded finance. It's been really fantastic event so far, really pertinent information coming out around how embedded finance can really help both banks and corporates. Firstly, it can help create value-added services for corporate clients, and then for the banks itself, it can help to transform their distribution channels and the way in which they engage with customers. Yeah, we talked a lot about the different data standards and different data architectures that exist in financial services and how they need to become interoperable. We particularly talked about ISO 20022 and that standard that's coming into the payment services industry and the way in which that's going to really transform financial services. But really, banks and fintechs really have to have the latest technology, because it's not just good enough to be able to ingest that data. You need to have an event-driven architecture that enables you to use that data to better service customers, whether that be small retail consumers or large corporate businesses. Corporate banks are facing a number of challenges in relation to how they manage transaction banking. Firstly, it amazes me that even in 2022, the number of banks that are still operating on batch-based systems, that means that overnight they're processing huge amounts of information. That means they have to keep lots of redundant service capacity to one side, which is really, really costly. Secondly, that data that they're processing is typically kept in silos. So different parts of the bank will have different data silos, and getting that data extracted, joined together and insightful is really, really difficult. So they're not really able to provide insight to their clients, they're not really able to provide a real understanding of the solutions that their clients need, because they just cannot access that data. And then thirdly, what that means is they can't provide the right liquidity management solutions that help to add value for their clients. So today, to manage liquidity, most corporates are looking to use virtual account solutions. The problem is that legacy systems that banks have are typically not architected to enable that to happen. I've talked about data silos, I've talked about the batch processing, and these things need to be real time so that corporates have real visibility over their cash positions. So in order to do that, you need a system that has virtual management built in as a fundamental capability, because otherwise you've got to layer on top different systems, and then those integrations start to become very costly, and they're rarely real time, they're usually batch orientated, which means you just cannot get a position straight away on where all of your cash is across your various different bank accounts. So there's a number of liquidity challenges in transaction banking. Unfortunately, 10x is on the way to solving a number of those. We've architected our platform from first principles. So that means firstly having data in an event-driven nature so that you have access to real-time data whenever you need it. But then secondly, our virtual account structures are built and architected from first principles within the platform. That means instead of having to layer on a heavy integration with a third-party system to do liquidity management of virtual accounts, it's native and out of the box on the 10x platform. For real-time data to be really useful for corporates, you've got to be able to use it in a really effective way. So we've talked about liquidity management solutions, but for the bank itself and for the corporate itself, they're looking to get the best value and the best optimization for both interest, but also on the tariffs, the fees and the charges that they are charged by a bank. What typically happens today for a bank is that trying to get that data together in order to assess the whole customer relationship and all of that entity's transactional processing, all of the entity's transactional data across all of its different corporate structures is really, really challenging and really, really difficult. And typically they fail to be able to pull that position together. And what that means is it limits their product capability and the different tariffs and structures that they can charge for their corporate clients. So corporates get a raw deal. With the 10x banking platform, you can actually use a click-knock code approach to be able to utilize all of that rich data across all of the different entities of that corporate and create bespoke relationship-based pricing for your corporates. So there's some really big trends happening today. Firstly around payments, particularly in international payments and the change of messaging format for SWIFT. Banks and corporates are going to really struggle in that transition if they haven't got the right underlying technology to be able to do that, that's API first and API driven. And then secondly, as we've talked about, the virtual account structures is a way in which corporates can really simplify how they manage their banking relationships and optimise both interest and the amount of fees and transactions that they're charged for. So they're the big two themes for me.